Hey guys, thanks for exploring my website. And in this video, we're going to be talking about becoming your own bank. I know a lot of you see a lot of people online talking about this. A lot of them don't necessarily know what they're talking about, and they just kind of explain the hype and not the reality of it. So I want to explain this in high level detail so that you can know what you need to do to actually make this work and what type of policies this actually will work with. So what does it mean to become your own bank? Well, typically, what most people do is when they want to buy something, whether that's a car, a piece of real estate, uh, consolidate debt, whatever, they go to their bank and they usually get a high interest loan. And that's going to be a standard loan that they're going to have scheduled monthly payments. And if they don't make those payments, then there's consequences for that. So the concept of infinite banking works because you're operating as your own bank, meaning you're earning interest on borrowed money. So an example of this is in whole life insurance and IULs. These are policies that create cash value. And when you take out policy loans, the insurance company is giving you a loan against your cash value. Therefore, your principal balance is unaffected, and you're continuing to earn compounding interest based on the index or the dividends if it's a whole life policy, without interrupting that growth. And that's in theory how you become your own bank. So here's an example so that you can really understand it. Let's say that this is you, all right, and you have an IUL account with 500,000 AV, which is accumulated value. When you earn interest and it's credited every year, it's not credited on the cash value or the surrender value. It's credited based on how much dollars you have in AV. Now, let's assume that you want to make a $200,000 purchase for a real estate investment. I do a lot of these policies for real estate investors or people looking to pay off debt. So this is typically what they do. Now, what happens is if you go to the insurance company and you say, "Hey, I need 200,000 for my policy," and you try to withdraw it, the insurance company is going to say, "Well, why would you withdraw the 200,000? Because if you withdraw it, now your AV is only going to be worth 300K. How about we give you a $200,000 loan at, let's say, a 5% interest, and you don't ever have to pay it back if you don't want to." And because the insurance company is giving you the 200,000 out of their money, your AV is unaffected and it's still in the market earning, let's say, 9%. So what happens is, if you do this the right way, is you have 500K, you borrow 200,000 from the insurance at 5%. You're earning 9%, let's say at 500K. So you're earning more money on larger lump sums. And let's say the loan, we'll call it negative interest, is earning less interest on less sums of money. So this would be called a positive arbitrage. Now, in cases like this, you don't want to borrow money and never pay it back. Because what happens is, even though you're borrowing from it, you have something called a surrender value, right? Or SV. That's like your actual net cash value. So if you have a 500,000 AV and you borrow 200,000, you actually only have 300,000 in SV that you could borrow from again. You can't do unlimited loans like that. That would be crazy. That's bad business. So what most real estate investors will do is they'll put the money in, they'll borrow the money out, they'll go do their real estate deal, and then after they're done flipping the property or whatever it is, or they refi out of it, they'll pay that 200,000 back plus the 5% interest, and now their SV or the surrender value is back to that 500K plus the interest that they earned. So that's really how this works. Now, a lot of people sell really bad IULs, and they sell products that you can't do this with because they forget to tell you something about an SC. SC is surrender charge, and this lasts for 10 years to 15 years in some policies. Think about it like this: a surrender charge is not a fee, but it's like a withhold. So they're going to withhold a certain percentage of the total AV in the account, and then they're going to release it to you over the course of 10 years. So let's say that you go and your cost, let's say you drop in $100,000 year one. Your cost of insurance is $5,000. So you have $95K in AV after you pay the cost of insurance. But let's say that your surrender charge is $20,000. So you really only have $75,000 in surrender value that you can actually use. So this is where we come in. So we utilize an exclusive IUL contract that less than maybe 3,000, 5,000 agents in the entire country have. In order to get this contract, you have to be hand selected by one of the agents that have it, and you need to go through rigorous training to make sure that you're the right fit for the company and the product. And what makes it so strong is, especially for complicated strategies like this, we could waive 100% of the surrender charge, meaning you'll have access to 100% of your accumulated value after the first year. That is what's going to empower you to make this really happen. Because if you do it the other way, what you think is going to happen is not going to happen. So that is why you're here. And if you're looking to do strategies like that, there's nowhere else you should go besides booking a meeting with one of my agents that specialize in becoming your own bank, and they have the right product to support the things that you want to do. Now, there's other ways that you can use this, right? For example, let's say buying a car. So when most people buy a car, all right, so let's just erase this really quick. Because when you fund an IUL the right way, it's going to change the way that you do things. So let's say that you want to buy a car, okay? And let's say that this car is $50,000. Let's assume you have an IUL with 100K in it. Now, typically, what do you do now? You go to the car dealership, you make a deal with the salesperson, you agree to a $50,000 sell price, you fill out a credit app, and then now you get maybe a 10%, 9%, 12%, or more car note for 60 months, and you have scheduled monthly payments. So now when you buy the car, you're buying the car at the high, and then as soon as you drive off the lot, it goes down in value. If you get into an accident, it goes down in more value. So you're 100% going to lose money no matter what you do if you buy cars the traditional way. But when you are your own bank through the process of an IUL, that's not the case. You can make a profit on every single car that you buy. So, for example, let's say you make a deal for $50,000. You go to the insurance company, you take a loan for $50K at 5%, which is less interest than you would pay the bank. You go and you buy the car cash. Your AV is worth 100K, even though you took 50K out to buy the car. Now you own the car outright and you don't have any scheduled monthly payments. So what you're going to do is whatever you were going to pay the bank, you're actually going to pay back your IUL those payments. So now you're paying yourself back just like you would have banked. Over the course of 5 years, you would have paid back the $50,000 that you borrowed. You own the car outright, and you've been earning, let's say, 9% compounding on $100,000. So by the time you pay off the car, you would have made tens of thousands of dollars in profit just because the money was growing in the index. You'd have paid back the money that you owe to yourself. And then if you want, you can sell the car back for probably 50% or more. And now you are significantly profiting on every single car you buy in the future. Wouldn't you agree that this is a better way to make purchases? And you can use the same strategy to pay off credit card debt. So if you have a lot of credit card debt that you're paying 20% interest, you could just borrow money, put money in your IUL, borrow from it, pay off all the debt, and then pay your IUL back while earning, let's say, an average of 9% on the AV. So I hope that this makes sense for you. And if you want to learn more about this and you want to get a custom plan tailored based on your scenario and your needs, Book an appointment below. You'll see the agent's face. That's the person that you're actually going to be meeting with. Every agent that you see on that website has been trained by me and went through all of our training, which is hundreds of hours, and all the insurance companies training. So they're well equipped to service any type of strategy that you need. All you need to do is book the meeting. And when you meet with the agent, say, hey, I was on the website. I saw the video of Mike talking about become your own bank. And that is exactly what I want to do. Can you help educate and design one of these for me? And they'll take care of you. So if you're interested, click the button below, find a date and time that works for you, and please respect your time and respect the agent's time as well. Thanks so much. Hope to see you on one of the meetings.